What happens when the world's biggest streamer tries to swallow one of Hollywood's most iconic studios and a rival crashes the party with a hostile bid? That is exactly what is playing out with Netflix, Warner Bros. Discovery, and Paramount. This is not just about your favorite shows, it's about tens of billions of dollars, control of IP, and the endgame of the streaming wars. In this video, I will explain what Netflix is buying, why Paramount went hostile, and what it means for shareholder value. So, let's get into it and let's follow the money. Warner Bros. Discovery really has three businesses: the Warner Bros. TV and film studios, HBO streaming, and the linear cable networks like CNN, TNT, TBS, and Discovery. Netflix has agreed to buy the studio and the streaming assets, essentially Warner Bros. Plus HBO Max, for roughly $72 to $83 billion in enterprise value, or about $28 per WBD share. The cable networks are carved out into a separate company called Discovery Global and are not a part of the Netflix deal. Paramount tried to buy all of the WBD shares and lost. Now they're back with a hostile, all-cash, $32 per share offer for their entire company, including studios, streaming, and networks. And they're pitching it directly to the shareholders as a simpler, easier to clear antitrust than Netflix transaction. The board prefers Netflix. Paramount is saying, ignore the board, take the cash. For Netflix, this is a shift from the we build to we buy. By acquiring Warner Bros. And HBO, Netflix would own one of Hollywood's deepest libraries: DC, Harry Potter, the classic Warner catalog, and decades of HBO series. That strengthens its slate and reduces long-term licensing risk. Merging Netflix and HBO Max also combines two premium subscriber bases that supports higher pricing and more content in one app, thus lower churn. Netflix will control the full stack from greenlighting to global distribution. It can use viewing data to guide what the Warner Studios produces, pushes those titles worldwide through a single platform, making each dollar of content much more efficient. Financially, Netflix is targeting cost synergies in tech, marketing, and back office, plus revenue upside from cross-promotion and international expansion of HBO and Warner Bros. The big risk is antitrust. As the dominant global streamer buying another major studio and streaming service, it will face intense scrutiny, possible concessions, and time delays. So, Netflix deal is high beta, high synergy bet, focused on growth assets, but with serious execution and regulatory risk. Paramount's logic is different. Instead of a carve-out, Paramount wants the whole WBD package: studios, HBO Max, and all the linear networks. Its hostile offer gives shareholders a higher headline price, all cash instead of stock, and the narrative that regulators should prefer a stronger number two over an even more dominant Netflix. Strategically, Paramount is pitching itself as a potential second Disney. Combining Paramount and WBD would create a mega studio with large franchise farm system that can feed films to theaters and series to streaming. Paramount also sees cost synergies from merging Paramount Plus with WBD streaming assets and cutting overlapping marketing, tech, and content spend. The linear networks will be managed as cash cows, with their cash flow used to pay down debt deal and streaming investments. The trade-off is structural. Paramount would fully inherit secular decline in cable, falling audiences, ad revenue, plus the complexity of integrating two studio systems and multiple streaming brands. Put the bids next to each other. Netflix plus WBD gives one dominant global streaming platform backed by a very deep IP library and no direct exposure to declining cable networks, but heavy antitrust risk. Paramount plus WBD creates a second Disney-style studio and streaming group, upgrades Paramount Plus using WBD's IP and HBO brand, and keeps the cable networks as cash generators that also bring long-term drag and integration complexity. From a shareholder's value perspective, here's the trade. Netflix is making a concentrated bet on global dominance in a streaming and IP. If regulators approve something close to the proposed structure and Netflix captures the synergies, the combined company could command premium valuation multiples as the clear category leader. If approval drags out for regulators force major concessions, a lot of that value gets destroyed. Paramount offers a higher immediate cash payout and potentially easier regulatory road, but leaves investors with a more complex business, a big studio and streaming portfolio tied to structurally declining cable. Success will depend on disciplined integration and using scale to truly differentiate, not just becoming a larger, slower conglomerate. At a capital allocation level, both bidders are betting that consolidation is the endgame of the streaming wars. Netflix is paying up to lock in scarce IP and entrench its lead. Paramount is using financial engineering and regulatory narrative to build a second Hollywood major that keeps Netflix in check. If you were a WBD shareholder, you would be choosing between Netflix's higher risk, higher upside strategic merger or Paramount's cleaner cash exit with more legacy exposure baked in. Tell me in the comments which one would you take and why. And as always, thanks for watching.